Welcome to StokTok's deep dive into Equinor. Equinor is a global energy company headquartered in Norway, operating integrated oil and gas exploration, production, and marketing across multiple continents, with a strategic pivot toward renewable energy and carbon management. As of May 1st, the stock is trading at $39.71. Over the past 52 weeks, Equinor has traded between a low of $22.26 and a high of $43.46. The 50-day moving average sits at $36.79, while the 200-day moving average is at $27.18. The stock is trading above both these key averages, indicating a structural uptrend in place. The Relative Strength Index, or RSI, is at 56, which is neutral territory, suggesting neither overbought nor oversold conditions. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Equinor operates one of the world's largest integrated oil and gas portfolios, generating revenue through upstream exploration and production, downstream refining and marketing, and increasingly through renewable energy development. The company's competitive moat rests on scale, access to low-cost reserves in the North Sea, established supply chains, and long-term contracts with stable international partners. The business is cyclical, highly sensitive to commodity prices and global energy demand. Here's the StokTok score. Equinor rates a 36 out of 100, signaling caution. Breaking that down, Valuation scores 13 out of 20, suggesting the stock is not obviously cheap. Financial health scores 8 out of 20, indicating real balance sheet risk. Profitability scores 5 out of 20, which is weak. Growth scores 8 out of 20, reflecting structural headwinds in traditional energy. And smart money scores just 2 out of 20, meaning institutional investors are not actively accumulating this name. Now, valuation. The question every investor has to answer: are you paying the right price? Equinor is trading at a trailing 12-month price-to-earnings multiple of 20.9 times, which is elevated for a commodity-exposed energy company. The forward price-to-earnings multiple is much lower at 8.16 times, which suggests the market is pricing in meaningful earnings compression ahead, a significant warning flag. The price-to-earnings-to-growth ratio, or PEG, stands at 0.81, which actually appears attractive on its surface, but that is misleading given the fundamental headwinds in traditional oil and gas. The enterprise value to EBITDA multiple is 2.89 times, which is reasonable for the sector, and the price-to-sales ratio is 0.87 times, indicating moderate valuation relative to top-line revenue. Our DCF, or discounted cash flow analysis, suggests the stock is trading at a 0% margin of safety to intrinsic value. In other words, it is priced exactly at fair value with no buffer, which means there is limited downside protection if sentiment shifts. Turning to the competitive moat, the business benefits from geographic advantages in established producing regions and long-term customer relationships, but the moat is not durable. Energy transition and volatility in commodity prices create structural headwinds that no moat can fully insulate against. Wall Street analysts have a consensus mean price target of $37, with a high target of $41 and a low target of $32. 6 analysts cover the name. That implies potential downside of around 7% from current levels if the consensus is correct. Let's examine the latest earnings. In the second quarter of 2025, Equinor reported earnings per share of $0.81, beating analyst estimates of $0.67, a solid operational beat. However, revenue came in at $25.3 billion, missing consensus expectations of $105.98 billion, a significant miss on the top line. Revenue on a year-over-year basis declined by 2.8%, signaling contraction in the underlying business. Operating income reached $4.87 billion, and net income came to $1.31 billion. The market reaction after hours was flat, suggesting investors had already priced in mixed expectations. The miss on revenue, coupled with the year-over-year decline, raises questions about underlying demand and production trends. Comparing to sector peers, companies like Shell, BP, and ExxonMobil trade at forward multiples ranging from 6 to 9 times earnings. Equinor at 8.16 times forward is in line with peers, but that is cold comfort given the earnings quality concerns. Market sentiment around Equinor leans bullish, with a sentiment score of plus 0.35 on a -1 to +1 scale. That bullishness is driven by operational momentum, share buybacks for employee programs, and positive production updates across its portfolio. However, that optimism is tempered by broader ESG concerns around fossil fuel industry profitability during periods of geopolitical tension and the long-term energy transition. In our view, valuation is neither obviously stretched nor obviously attractive. The stock is fairly priced at consensus estimates, but those estimates themselves carry significant downside risk if the oil market weakens or production targets are missed. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point accounting quality checklist that flags red flags in financial reporting. Equinor scores 5 out of 9, which is below the threshold of 6 that typically signals quality financial health. That means we are seeing deterioration across multiple accounting dimensions. This warrants scrutiny. The Altman Z score is a 5-component bankruptcy risk model. Equinor scores 2.66, which places it squarely in the gray zone, not immediately at risk, but certainly not in the safe zone above 3.0. The gray zone means the company is at elevated financial stress and bears watching closely. On the balance sheet itself, cash to debt stands at 0.62, meaning for every dollar of debt, the company has only 62 cents of cash. That is a tight position. Interest coverage, the ratio of operating income to interest expense, is a healthy 29.81 times, meaning the company can cover interest payments nearly 30 times over. That is robust and suggests no immediate debt service crisis. The current ratio, a measure of short-term liquidity, is 1.27, which is marginally adequate. Anything below 1.0 would be concerning, but above 1.2 suggests manageable near-term cash flow. Debt to equity sits at 0.77, which is moderate. The company uses leverage but not excessively. In our view, the financial position is stable but not strong. The Piotroski score of 5 and the Altman Z of 2.66 together suggest this is a balance sheet under pressure. The company is not in default risk territory, but it lacks a substantial financial cushion. Should commodity prices fall sharply or production targets slip, the balance sheet could deteriorate quickly. This is a constraint on the upside potential. Next up, profitability. Is this business actually making money efficiently? The most critical metric here is return on invested capital. Equinor posts 5.23%, which is deeply concerning. A healthy industrial company generates returns well above its cost of capital, typically in the range of 10 to 15% or higher. At 5.23%, Equinor is barely covering its cost of capital. Management is not creating shareholder value at an acceptable rate. That is a structural problem. Gross margin comes in at 36.3%, which is reasonable for an integrated oil company. The business retains roughly a third of revenue after direct operating costs. Operating margin is much stronger at 23.49%, indicating that Equinor controls its overhead effectively. However, the net profit margin drops to just 4.85%, a dramatic compression from operating margin. That gap is driven by taxes, interest expenses, and other corporate costs. The free cash flow margin, the percentage of revenue that converts to cash available to shareholders, is 5.65%. That is adequate but not exceptional. Notably, in the second quarter, the company posted an operating income of $4.87 billion on revenue of $25.3 billion. That yields an operating margin of approximately 19% for that quarter, down from the longer-term average, suggesting margin compression is occurring in real time. The net margin in that quarter deteriorated to approximately 5%. In our view, profitability is a significant weak point. The return on invested capital of 5.23% is the core issue. Capital deployed into this business is not generating returns that justify the risk. Combined with the declining margins evidenced in the latest quarter, the profitability picture is deteriorating. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years is negative 10.1%. The company is shrinking. Over the trailing 5 years, revenue growth is positive 23.6%, which appears contradictory. But this reflects a peak in revenues 5 years ago followed by systematic decline. Book value growth over the trailing 3 years is negative 1.5%, essentially flat and pointing downward. These are not the metrics of a growth business. They are the metrics of a mature, cyclical business in structural decline. In the second quarter, revenue declined 2.8% year-over-year, confirming that contraction is ongoing. Management has not provided clear forward guidance on production ramps or revenue inflection points. The dividend yield is 3.72%, which is attractive on an absolute basis. But dividend yields are only meaningful if the underlying business can sustain the payout. Given the negative revenue growth and weak return on invested capital, the sustainability of that dividend is questionable if the business deteriorates further. In our view, growth is the second major problem with this investment. The 3-year revenue decline of negative 10.1%, combined with negative book value growth, paints a picture of a business that is shrinking in real terms. The 5-year revenue growth figure of positive 23.6% masks the fact that the company has given back most of those gains in the recent 3-year period. Until management can demonstrate a credible path to revenue stabilization or growth, whether through production increases, cost cuts, or renewable energy contribution, this business should be viewed as declining, not growing. Now let's talk smart money. What institutional capital is actually doing with this name? 8 top-tier investment gurus currently hold Equinor in their portfolios, but the key metric is directionality. Only 1.9% of 13F institutional filers are net buyers, meaning they own the stock in more than half their holdings and are increasing positions. That is an extraordinarily low percentage. The threshold for net bullish positioning is typically 50% of filers buying. This tells us that the vast majority of institutional money is either holding the position passively or selling out. Insider ownership is essentially 0%, which is striking. Management owns virtually no stock in the company they run. There were 0 insider purchases in the trailing 3 months and 0 insider sales, no activity whatsoever. When management is not buying their own stock, it typically signals a lack of conviction about the upside. 2 specific gurus are notable. Christopher Bloomstrand at Semper Augustus holds 1.63% of his portfolio in Equinor and increased his position by 4.3%, a modest add. Richard P. Zena at P. Zena Investment Management holds only 0.01% and increased that position by 37.09%, a dramatic percentage increase on a very small base, so the absolute dollar commitment is minimal. Neither of these moves represents a major institutional conviction signal. In our view, the smart money positioning is weak. The near 0 percentage of 13F filers that are net buyers, combined with 0 insider ownership and 0 insider activity, tells a clear story. Institutional investors do not believe in the upside of this name. The fact that 8 gurus still hold it likely reflects legacy positions rather than active conviction. And finally, the verdict. Let's bring it all together. On valuation, the stock is fairly priced at consensus earnings estimates, but those estimates carry significant downside risk if commodity prices weaken. On financial strength, the balance sheet is stable but under pressure, with Piotroski and Altman Z scores signaling elevated stress. On profitability, this is the core issue. Return on invested capital of 5.23% is unacceptable, and margins are compressing in real time as seen in the latest quarter. On growth, the business is contracting, not expanding, with negative 3-year revenue growth and negative book value growth, offering no clear catalyst for reacceleration. On smart money, institutional capital is neither accumulating nor supporting the thesis, with near-zero insider ownership and minimal 13F buying. The second quarter earnings beat on earnings per share but missed badly on revenue, with year-over-year revenue declining, which reinforces the growth and profitability concerns rather than alleviating them. Bringing this together, Equinor is a fairly valued cyclical energy company whose underlying fundamentals are deteriorating. The stock is trading at fair value with no margin of safety. The balance sheet is adequate but not fortress-like. The business is shrinking and not generating adequate returns on capital. Institutional investors are not accumulating the stock. The setup does not warrant conviction at the long side from our perspective, and the risk-reward appears balanced to slightly negative. This is best viewed as a trading position for those with specific commodity views or a defensive hold for those already long, rather than a compelling new buying opportunity. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Equinor. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.